How are dollars created? If you want to forecast future inflation, you need to understand what money is and how it is created. If Milton Friedman says inflation is always a monetary phenomenon, you have to understand how the money supply is actually increasing. We're going to go over the 3 ways money created and some common misconceptions that people think dollars are created. So the 3 ways money are created are: 1, bank lending. This is the vast majority. 2, deficit spending through the government. Think back to stimulus checks back in 2020. And 3, this gets very complex and hardly anybody talks about it: the selling of treasuries by non-bank entities. Don't worry, we'll go much more in detail. And step number 3.
Banks loan money into existence, or rather, you borrow money into existence. When you swipe your American Express card or whatever, right, to buy lunch or whatever, right, it's not necessarily like American Express is, transferring, $20 from their account to the restaurant's account. No. They're a long, complicated process. What's actually going on is $20 is actually being created out of thin air. So the way I like to think of it is, picture in your mind a $20 bill. And on the $20 bill, imagine the American Express logo, imagine the Chase logo, or the Bank of America logo, or whatever bank's logo on it. These are promises to pay dollars by an institution that have been created. And the reason the institution is willing to create it is because when you sign, the credit card receipt, or you sign your mortgage note or whatever, or when you sign the promissory note where you will pay it back, this gives the bank the corresponding asset to issue the liability, which is, again, that dollar with, the bank's logo on it.
And that is the vast majority of all dollar supply in the world. It is through this bank lending. So step number 2 is government deficit spending. That is when the government will issue a bond and the Fed buys that bond, or a bank. I'm going to use banks or the Fed because that is the same thing. There's no velocity on banks' money. So that is the same thing. The QE, the bank reserves that they have 0 velocity. They're not buying goods and services. Therefore, it is not impacting consumer goods or services. So if a bank or the Fed buys a T-bill or any sort of government bond, that is then going to be deficit spent into the economy. Money is created in that step when the government spends the money into existence and credits somebody's account. Anytime someone credits your account with dollars, money is created, because it's not the bank that is taking money from someone's account and putting it over here. They just add dollars to your account. So I think a lot of people understand the first 2 steps. The third step is where we're really going to get into the weeds, where if non-bank entities sell treasuries, dollars are created and M2 money supply actually increases. The reason behind this is, if let's say I'm holding a 10-year treasury, Justin is as well. What happens when I buy the treasury? At first, I have dollars on on the asset side of my balance sheet. I have dollars. On the liabilities, I have all my debt on liabilities and stuff. So when I buy a treasury, those dollars are then swapped with treasuries, but the dollars are then, the bank takes them off their liability side, and on now my assets, instead of having dollars, I now have a treasury. So money's then destroyed. Every single person went out and bought treasury. M2 money supply would actually decrease.
We always like to talk about counterparties and counterparty risk. We always focus on individual banks or whatever, right? I think maybe we want to take a step back and even go up higher and say, listen, there are 2 theoretical counterparties in existence: the commercial banking system and the government. If you're taking your value, so it's your value to you, liability to the commercial banking system, you're changing the counterparty from the commercial banking system to something else besides the commercial banking system, in the case of a treasury, be it the U.S. government, then what's going on is that you are taking money out of the commercial banking system because it is being replaced by the counterparty of the government. So that's kind of how I think about it from a very, very broad perspective: is counterparty class, commercial banking system, non-commercial banking system.
Okay, so now the opposite is also true. So if money is destroyed when non-bank entities, a non-bank entity is anything that is not a bank. If they buy treasuries, dollars are destroyed on the real world balance sheets. But the same is true if you sell treasuries. If any non-bank entity sells a treasury, dollars are created, because, again, as Justin was saying, we go from having the counterparty from the government to the bank. They don't take dollars and then put them into your balance sheet. They create them out of thin air. People think the M2 money supply just goes straight up, but if we went on a day-to-day basis, it would look much more like a heartbeat going up and down and at like a vast rate, but that's never trackable. And if you go even further, the deepest form of dollars are not even in the US. They're mainly offshore. That's completely untrackable to absolutely nobody in this world.
Funny how that works out. So, Josh, here's a question. When you, let's say, create a Tether or a Circle or whatever, right? What's going on with the monetary supply there?
It's just increasing. Like when these people are creating Tether, it's just the same thing. They're inflating the Tether, and then they go buy Bitcoin, inflating the price of Bitcoin. It's the exact same thing.
Yeah, yeah. So what I think is particularly interesting in that front is that like when you put money into Tether or USDC, assuming you're an Alameda Research or whatever, you're someone who can basically have it issued on your behalf, whatever, right? Those dollars are still staying in some circle controlled account. I guess now it's BlackRock or whatever, or soon to be BlackRock. But the interesting thing is that you now have a dollar equivalent that's been magicked into existence. Now, to be fair to Circle, I'm not saying that Circle doesn't have the cash. My suspicion is they probably do. But the point is that just as there is still $1 in the commercial banking system as the counterparty, you now also have this additional $1 of value that's been created in crypto land. And so maybe I should amend my prior statement to say, well, there used to be two big counterparties, the commercial banking system and then the government or a governmental entity or whatever, right? And maybe we're getting a third major counterparty by the wild west of crypto land. So anyways, I just pause on that because I think it's a very interesting phenomenon, because with these stable coins you're expanding the functional dollars that are spent in the economy, because the average person, at least in crypto land, is going to lack, I suspect, the resolution to distinguish between a tokenized dollar and a real dollar or a dollar equivalent that's backing it. And that's just assuming whoever's backing it actually has, the dollars to stand behind it. But the net effect is, I think this is what you said, there are more dollars or more dollar equivalents in circulation. And these dollars, especially in crypto land, they're chasing a relatively same amount of assets, which probably just serve to bid up the asset prices over and over and over again, or deflate the asset prices when you see collateral being pulled out of the system. That is the crypto system.
Okay, so quick quiz. I think people get the first two forms of inflation, but what about the third? Are dollars created when non-bank entities buy treasuries or when they sell treasuries? It's when they
No.
sell treasuries.
But see, here's the thing. Like, even like, say, let's say you go and sell a treasury. See, yeah, dollars are created, but is it a net dollar creation? Because at some point in time, you would have bought the treasury.
When you buy a treasury, money's destroyed, and then if you sell a treasury, money is then created.
Right. But my point is that those things are actually going to.
Yeah, yeah. Like it will offset sometime in the future, but at that point in time, money is destroyed or money is
If
created.
you look on the whole of the net, there is no actual net increase of value, because the money that's coming back in is the replacement for money that was siphoned out when the treasury was bought, however, long ago in the past. You see my point there? Yes, it increases
Well,
it, but it's
all
it's
like, if you buy a treasury too, though, then you're also going to be funding the government, which will then be put back into the economy. So it's money's destroyed.
oh, okay,
So
okay, I see it.
money's destroyed when you buy a treasury. The government spend it, then there's a net wash. But then if you sell that treasury, then money's created. To go a little bit deeper into the weeds now, is it if you're really sharp, Justin actually just gave this pushback on me. So when you first buy a treasury, money is destroyed. But then you could say, well, if you sell it, then in the future, money will be created again. That's a net wash. Not exactly, because when a non-bank entity buys that treasury, what happens? The TGA accounts gets filled. The government then goes and deficit spends those dollars. And we know when the government deficit spends, money is created, unless it's from non-bank entities. Then it's a net wash, because if first money is destroyed, then the government spends it and money's created, that just equals out 1-to-1. So there's a net wash. Then what happens is if the person sells that treasury, then money is created. So the nuance is so key. So when people are just talking about M2 money supply going up or down, like they have absolutely no clue what they're talking about. Now let's go over some common misconceptions. Let's start with QE. Everyone just talks about how QE is money printing, blah, 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 blah. Inflation, hyperinflation going to the moon. No, not at all. What happens when the Fed does QE? They print bank reserves and they go and buy treasuries. But who do they buy those treasuries from? They buy them from the banks. And on the asset side of those balance sheets, when the Fed buys treasuries from a bank, nothing happens in the real economy. People would say, well, then the bank has more capacity to lend. Yes, but then that also comes down to the bank actually lending. And we know that they are not lending because they see too much risk in the economy. So if the Fed were to buy the treasuries from the non-bank entities, the irregular persons, then money would be created, but they're not buying it from the non-bank entities. They're buying it from the banks. So QE is not money printing, and the people who says it is, you should lose credibility in what they are saying, because you cannot forecast inflation if you do not understand how dollars are created. So, Justin, when we're looking out for the future of inflation, we have to look at mainly the first two metrics: bank lending and government deficit spending. I personally do not see, well, we can clearly see that the banks are not lending to the capacity that they used to prior to 2008. That is when the global financial system broke, and it has never recovered. And it looks like it will not recover until something changes. So banks are not lending to the capacity that they need to drive the growth in inflation. And governments, they can fill that hole. We saw that in 2020. That is the big portion of why we're seeing so much inflation now due to government intervention and deficit spending, handing people money and preventing them from working. What I think the most likely outcome right now is my base case. I think that inflation's probably peaked out. We're probably going to see some slight disinflation. Actually, I'm not entirely sure because we're seeing food probably price is going to skyrocket as well as energy, and the main components of CPI are. Sorry, I'm going off into the weeds here. Basically, I think the government will step in when something breaks. I think something will break in the banking system because they're going to continue to raise rates until something breaks. So I bet something in the credit market will freeze, something breaks, then the government comes in, floods the hole, will reverse course it when instead of doing QT will come up, do QE infinity, and as well as extreme deficit spending, maybe stimulus checks going out instead of 2 trillion to do 5 trillion, 10 trillion, who knows? Then I think we'll see another massive spurt of inflation because new dollars will have been created.
I think when you're considering quantitative easing, it's essentially an asset swap. And so it is true when people howl that the Fed's printing money, the answer is not quite. I mean, I would soften it just ever so slightly and say what quantitative easing does, it's a mechanism for banks to otherwise swap out bad debt, perhaps on their books, think mortgage-backed securities from 2008, with less bad debt, bank reserves or whatever, right? And in the process of clearing out this bad debt from the banks and putting on the Fed's balance sheet, the banks have been disencumbered from this. And if the banks have been disencumbered, theoretically they can lend. And so people like kind of get part of the theory right. But when you, as you said earlier, Josh, it's the nuances when you start exploring, it's like, okay, well, listen, this is actually the mechanism that goes on. Think back to the PPP loan program from the COVID era or whatever, right? Ultimately, banks were making the loans. So that's the creation of money because, you have these Chase dollars, these Bank of America dollars, whatever, that are being created. But then the loan itself, so the liability from us, the borrower, or the asset from the institution is being put back onto the Fed's balance sheet or otherwise being directly monetized. And so my take is that I suspect that the Fed and the government itself is looking for a way to print money directly into the hands of us consumers, whether they use the commercial banking system, whether they use a CBDC. I don't know what the handmaiden is going to be, but I would note that there are some other stocks I follow pretty closely that if you create a crisis that can't be closed out, this would create the liability from the commercial banking sector that would be offset by dollars being put that you and I could spend. And what's more, it gives the Fed the opportunity to take that liability from the banking sector and put it on its own books to issue currency into the real economy. I know that's a bit tinfoil hatty, but
Basically talking about a central bank digital currency. That is where the Fed could directly implement dollars into the economy, which right now they can't. And period, anyone that says that they can, the only possible way is if the Fed buys bonds from non-bank entities.
Yeah, or the Fed has to have a handmaiden. The Fed has to have a patsy somewhere in the equation.
Yeah, that's not them directly implementing it though. The Fed cannot directly do this. They need a third party. They either need the banks or the government. And right now that's not happening. So guys, if you like these kinds of super in-depth explaining videos, let us know because we'll continue to do them. If you want us to get down and we'll maybe make some graphics for the next one or something, you have to know let us know if you actually enjoy these types of videos because we like making them and people need to understand the intertwines of the market, because if you don't, how are you going to understand and forecast what's going on in the future? So thank you guys for watching and we'll see you in the next